Hello friends, today we are going to discuss a key concept that links exchange rates between two currencies to their underlying interest rates. This concept is called interest rate parity. So interest rate parity says that the difference in interest rates between two countries equals the difference between their spot and forward exchange rates. This prevents any risk-free arbitrage opportunities. So what are spot and forward exchange rates? To know that, you can watch my video on this topic, link is in the description. Now coming back to the topic. Interest rate parity says that if one country's interest rate is higher, its currency should depreciate in the forward market such that the returns are equal for investors whether they stay domestic or invest abroad. Let's look at an example to understand this. Let's say INR to USD spot rate is at 90. INR interest rate is 6% and USD interest rate is 4%. So a US based borrower can borrow $100,000 and convert them into 90 lakh INR at spot rate. Then he invests that in Indian government bonds at 6% for a year. So at the end of the year, he would get 95.4 lakh rupees. Now in scenario 1, we assume that forward rate is same 90. That would mean he would get 1.06 lakh USD. He then pays the USD interest rate of 4,000. Hence risk-free gain on this carry trade is $2,000. Now in scenario 2, we assume there is no arbitrage and then accordingly we'll adjust the forward rate. In this case, the rate would be 91.73 and at this rate INR is converted to 1.04 lakh dollars. So out of this, when we reduce the same USD interest, we get 0 P&L. So forward rate is spot rate into 1 plus 6% divided by 1 plus 4%, which is 91.73 INR per dollar. So according to interest rate parity, a higher interest rate in India relative to the US means the rupee is expected to depreciate over time to keep markets fair. This relationship between interest rate differentials and currency movement is key for us to understand global capital markets. Thanks for watching. See you in the next video.